Okay, let's continue with the exercises from Chapter 5. The first one is number 18. That's labeled Sales Tax. A sale of merchandise on account for $36,000 is subject to an 8% sales tax. Should the sales tax be recorded at the time of the sale or when the payment is received? What is the amount credited to the sale? What is the amount debited to receivables? And what is the account to which the $28.80 is credited? Well, first, the moment the transaction happens is when we record it, so at the time of the sale. And B is, what is the amount credited to sales? Well, the only thing that we sold is the $36,000. The sales tax is not ours and should not be a part of the $36,000. What is the amount debited to AR? Well, the entire thing is going to go to AR, but we're going to have a sales tax payable and another account called just sales for the $36,000. So $36,000 to sales, another, and it tells us here it's $28.80 to the payable, but the entire thing needs to be collected. And then letter D, it just reads, what is the amount to which that is credited? Well, of course, just as we said, sales tax payable. In fact, if you look at number 19, that's our journal entry, debit to AR, credit to sales, and then a credit to the payable. The business is just a conduit for that sales tax payable. So we record it, and in the payable is a liability because it's not ours, and then we essentially remit it when it's due. So first, we just put it in the payable, and then we credit cash and debit the payable when we turn it over to the government. Number 19, sales tax transaction. Journalize the entries to record the following selected transactions. Sold $640,000 of merchandise on account subject to sales tax. The cost of goods sold was $385,000, and then paid the $61,750 to the state tax department. So whenever you sell inventory, there's two transactions, right? So this first one, just like we know it, AR and sales tax payable. And then our cost of goods sold, the cost entry, so debit cost of goods sold and credit inventory. And then just as we had talked about with number 18, when you actually have to remit it, you will debit this sales tax payable and credit cash. So in this case, they said $61,750 was due to the government. 21, income statement and accounts for retail. So for the fiscal year, sales were $46.68 million. Cost of goods sold was $28 million. What is the amount of gross profit? Well, we've done that already in not only this chapter, but other chapters. Gross profit's the net. Sales minus cost of goods sold is our gross profit. Letter B, if the total operating expenses were $5 million, could you determine net income? Well, no. It's probably the exact answer because there could be other income and expense. Generally, there's not much of that, so you would be very, very close, but technically the answer would be no. Letter C, is customer refunds payable an asset, a liability, or equity? And what is its normal balance? Well, it's a payable, so it's a liability, and of course it's got a credit balance. Estimated returns, inventory. What is that? Well, it is an asset. It's inventory. It's an asset and has a normal debit balance. Not too difficult. 22. So it talks about inventory shrinkage. So this tire company's perpetual inventory records indicate there is $3.145 million on hand. The physical count says it's $3.1135 actually on hand. So our records are different than our actual count. What do we debit and credit? Well, it's obviously there's a $31,000, $500 difference, meaning there is $31,500 on our records that need to get taken off because actual is less. So where could that happen? Well, we call it shrinkage, but it could be actually from journal entries. It could be that we sold something, we didn't record it. It could be theft. That's the big one. If you're dealing with milk or liquid type of items, it could literally evaporate. So some of that's normal evaporation. But we don't have an account on our financials called debit theft expense or debit evaporation. It's not common, so we don't do that. We credit the inventory because in fact, the inventory account needs to go down, but it gets debited to cost of goods sold. So in this entry, essentially, if you notice, this is exactly like this entry right up there. The deal is the sales entry is 0. We don't have anything, right? We didn't sell it. We don't have any revenue to record, but we do have the cost entry. So in this case, we just are basically taking a loss, but we debit it to cost of goods sold, though we have no sales to record. Number 25 is the next one that we said we would be doing, and it reads here, income statement for a retail. The following expenses were incurred by a retail business during the year. In which expense section of the income statement should each be reported? Selling, administrative, or other? Well, advertising, that's a selling expense. Depreciation expense on store equipment. Store equipment. Well, that's part of where we sell, so that also would be a selling expense. Number 3, insurance expense on the office, administrative. Number 4, interest expense on a notes payable. Interest expense on a notes payable would fall into that other category. Number 5, rent on an office, again, administrative. Salaries of office, again, administrative. Salary of sales manager, of course, selling expense. And then sales supplies, again, sales or the selling category. Moving to number 27. Number 27. Here's a multiple step income statement. It says on March 31st, the balance of the accounts appear in the ledgers of this furnishings company. Prepare a multiple step income statement. A multiple step. And if you go back in your text and try to identify a multiple step income statement, look at page 254. 254 has the multiple step income statement. Sales minus cost of goods sold equals gross profit. And then it lists all the operating expenses. First by selling expenses, and then secondly by administrative. And then you get to your operating income. And then if there is any other revenue or expense, and then you get to your net income. So looking at all of these accounts that they have listed in number 27, you will notice they've got a lot of balance sheet accounts. So there's a bunch of them in there that we will not obviously put onto this assignment, but there are also income statement accounts. So sales minus cost of goods sold gets you to your gross profit. There are only 2 items for one selling, one administrative, gets you to operating income. There is only interest expense for other, and then you get to your net income. What is the major advantage or disadvantage of multiple or single step? Well, the major advantage is right here. It tells you what your gross profit is. Because sales, we can easily identify, but we want to know what are we incurring in cost for those items that we are recording in sales. So by doing so, we get a number here, and in this case, it's 2.745 million. 2.745 million. So if you take 2,745,000 divided by 8,245, then what we have is our gross profit percentage. And in this case, it's a little over 33%. So 2,745 divided by the 8,245, we have a 33% gross profit percentage. Is that good or bad? Can't tell you. I don't know exactly what the furnishings industry should have for a gross profit percentage, but we can certainly track it from one year to the next. All right, the next one that we've got here is number 30. Number 30, and it's on page 281. It says, from the following list, identify the accounts that should be closed at the end of the fiscal year for a perpetual. Accounts payable, it's a balance sheet. Of course not. Letter B, advertising expense. That's an expense, yes. Letter C, cost of goods sold. That's an expense, yes. Letter D, that's a balance sheet item. Office equipment, no. Letter E, inventory. No, it's a balance sheet. Sales, yes. Supplies, balance sheet, no. H, supplies expense, it's an expense, yes. Wages payable on the balance sheet, no. Of course, what are the only accounts that we close? Income statement accounts, revenues and expenses. And then, of course, it's not on the income statement, but a dividend, but no balance sheet accounts. And then lastly, for this part of the video, 32 closing entries. Prepare the July 31st closing entries for this company. Again, what are the closing entries? This is coming from chapter 4. This is review. Our revenue and expenses, and then our dividends. So here, we debit our revenue. We credit all of our expenses. And the net goes to retained earnings. Whether it's a debit or a credit, in this case it's a credit, so that means that they had net income. And then our dividends entry. We debit retained earnings and we credit dividends every time. So number 32 gives you a whole bunch of other accounts, which you'll notice are balance sheet accounts. Those are permanent accounts. We do not close permanent accounts. We will stop there for a moment and then we'll continue on with the last two problems for this chapter.